Every month, millions of Indians quietly authorized a fixed amount to leave their bank accounts and go into a mutual fund. No drama, no market timing, no stress. Just a standing instruction doing its job. We call it an SIP, a systematic investment plan, and it has become one of the most powerful financial habits this country has ever built. But does it actually work? And if it does, how long do you need to stay invested for it to truly deliver? And what happens to your SIP when markets crash? How bad does it get? And how quickly does it get better? These are the questions that ET Wealth set out to answer this year in our annual SIP study with Crisil, one of India's most respected research and analytical firms. Some of the findings genuinely surprised us. To walk us through what the data says and what it means for you as an investor, we have with us today Piyush Gupta, who's director at Crisil Intelligence, who heads the research behind the study. It's Friday, the 12th of June. I'm Kayezad, Adajania. This is the morning brief. Hi Piyush, welcome to the morning brief.
Thank you, Kayezad.
So Piyush, I want to start at the very soul of our study. What our study says is that, if you stay invested in a mutual fund through an SIP for at least 10 years, your probability of losing money is zero. Now, how did you arrive at that number? Where did that number come from? I also wanted to ask you, is that number static or does it go up or down depending on the markets? Give us a little bit of context and background behind that magic number.
Right. So this is, of course, part of our ET Wealth Crisil SIP study. Here we examine the performance of actively managed equity funds across major categories. We looked at total of 120 schemes with the continuous NAV history dating back to 15 years. The key findings of the study is that historically, instances of negative returns reduce as the SIP duration increases. For example, 1 year SIP had around 23% of instances with negative return. This number falls to about 2% for a 5-year SIP and becomes zero for a 10-year SIP. It means if the investor had invested in any of these 120 schemes using a 10-year SIP, the investor would not have lost any capital in the last 15 years. In fact, as per our analysis, average 10-year SIP returns ranged from 7% to 28% in this period of analysis.
So now, as attractive as that number sounds, if you stay invested for at least 10 years and you won't make any losses across equity funds, what is the realistic minimum that you would want to give to, let's say, a first-time investor? Because, most of the people don't stay for 10 years in an SIP. What's the minimum that makes SIPs reliably work? And what is that number that you would give to the first-time investor?
So when we look at our data, I think what we notice is 7 to 8 years is an ideal horizon.
That's the sweet spot.
That's a sweet spot. If I have to give one number, 5 years has to be a minimum commitment period. Any investor who doesn't have horizon more than 5 years should avoid taking exposure to equity mutual funds. When we look at the data, stability in returns start improving meaningfully around 5-year period. For example, 80% of instances had a return in excess of 10%. This number, of course, improves to 98% for a 10-year SIP. The key distinction here is that while 5-year SIP improves meaningfully in terms of stability, longer holding period makes the outcome more stable.
Okay. But tell me, 7 to 8 years, you say is the sweet spot. But anecdotally, I'm saying, and I wanted to get your insights about investor behavior over here. Is it enough to stop people from panicking, the 7-year cushion? Or do they panic anyways when the markets go up and down? If you can give us some insights about behavior versus math.
Yeah, so the behavior can be different from the numbers that we have seen, right? And again, data shows that if you invest for long term, even during the market corrections, the drawdown on the SIPs are limited if you are invested for long term. If I were to quote here, a 1-year SIP at the time of COVID would have seen a decline of almost 50% before the correction started. In contrast, a 7-year SIP went down by 1% in the same period. And the recovery time for that SIP was about 13 odd days. So, of course, a 7 year does provide a cushion. It may not fully prevent the panic because investors can have different expectations. Somebody who has had experience of investing into equity market, possibly they are better prepared to go through the volatile markets and see the benefits of long term investing.
Another aspect, Piyush, we looked at the COVID crash this time and very startling numbers that the research came up with. For investors who had started SIPs 1 year prior to the COVID crash, on an average, they lost about 50% returns, and it took about 122 days to recover. Whereas, let's say somebody who had been continuing their SIPs 7 years before the COVID crash, they barely lost less than 1%, and it took them just about 13 days to recover. So, when you actually looked at these numbers going back 1 year to 9 years before COVID started, and assuming that an investor would have started his SIPs back then, did this data surprise you, and what does it tell you the relationship between time and pain?
See, directionally, we have always seen that we get better results whenever the investment horizon or the SIP tenor is longer in nature. What comes out very clearly in this study is the benefits are significantly high, not just during the normal market phases, but also during the period when there is a sharp correction. And we had that situation in 2020 when markets corrected significantly in a short span of time. And it was very visible that the 1 year SIP, which had a highest correction or highest drawdown, versus a 10 year SIP where you didn't have any correction, or rather the SIP still remained positive even during the bottom of the market. So it's not just the compounding effect that one gets, but it also helps the investor in going through the difficult phases of the market and taking maybe rash actions during that period of time when the markets are not doing well.
So, Piyush, we were talking about earning, 20% returns over a 10-year period. But another important or other interesting facet to our study was that, the chances of earning, let's say, 15% returns. And, that is where the returns really peak for all categories across mutual funds and SIPs. The time period required to earn that much of return, around 15% plus returns, is not really 10 years. It's about 3 to 4 years. And, then the returns taper. So, my question is that, why staying longer doesn't necessarily mean higher returns, but rather more predictable returns. Because, these are two very different things. And many times we see investors don't understanding the difference between the two.
Right. So a longer time horizon does not guarantee highest return, but it does provide better predictability. A 3 to 4 year period may capture strong market phases and therefore show higher probability of 15 plus returns. But those outcomes are harder to identify in advance. A longer holding period, of course, reduces dispersion, downside risk, emotional stress. The better trade-off for most investor is not chasing the highest possible return, but staying invested long enough for compounding to work.
Piyush, one thing which you have pointed out in your column in ET Wealth on SIPs, I mean, it's a very sobering fact. You said that, we've seen a generation of investors who've set multiple SIPs across multiple apps, and, many of them have no idea of where they are right now and what they own. So tell me, in terms of basic housekeeping, what are those 1, 2, or 3 things that investors should do today?
So SIP has been, in fact, the biggest success story as far as personal finance is concerned, right? SIP assets have grown sixfold in the last 6 years. Monthly SIP contribution today stands more than 30,000 crore. One of the key reasons for this success story is convenience that SIP provides for investors to invest into MF across market cycles. Some of the things that the investor can do is, first, they should review their consolidated account statement or cash statement that is provided on a monthly basis. Look at the full portfolio in one place. Then show the extent to which the investments are scattered across multiple schemes. Analyze the performance of investments to rebalance the portfolio. Review the underlying portfolio to understand the overlap across schemes. Add schemes if it improves the diversification in the portfolio. Don't add unnecessary schemes and have a large portfolio of multiple schemes. Ensure that the nominee details are updated and at least one family member is aware of all your investments which have been made in mutual funds.
Many investors have considered SIP as a standalone product. I mean, that is one misconception that people have. But the bigger misconception that people have is that, SIP is a path to success, forgetting the volatility. I have to wonder if we have perhaps oversold SIPs and made it oversimplified. I'm just playing the devil's advocate. But, 3 points that SIP investors should remember as far as their expectations are concerned, Piyush.
So, see, SIP again has to be looked at as a medium to invest. This is a tool which enables seamless investment into mutual funds. So, even if somebody does not have lump sum capital at a given point in time, they can gradually accumulate units through SIP and thereby build wealth over a period of time. So, one of the benefits most of the people talk about is rupee cost averaging. That anyway plays out across market cycles, volatile period. Having said that, it is not a tool which has answered the requirements of MF investing. Fund selection is still important. Portfolio rebalancing is still important. Reviewing the performance of existing portfolio schemes, looking at laggards and identifying the right set of schemes for an investor to invest into is still important. And also monitoring the portfolio on an ongoing basis and revisiting any changes in the portfolio has to be done by the investor. SIP is just a medium to participate into MFs. The other tenets of long-term investing, portfolio diversification has to be handled anyhow.
So Piyush, one important data that I wanted to draw your attention is that, the percentage chances of earning more than 20% returns, let's say in large cap fund over a 10-year period is virtually zero. Whereas in a mid cap fund, it goes up to about 17%. But in small cap funds, it goes up to about 42%. So which means that, the small cap funds have a larger chance of earning a higher return over the 10-year period as opposed to, let's say, a mid cap fund than opposed to, let's say, a large cap fund. So, when a new investor, a fresh investor, a first time investor, a young investor is investing in mutual funds through an SIP, what would you recommend? Would you rather recommend a small cap fund or would you ask them to stay invested in a large cap fund?
Yeah, so data does put a strong case for investing into, say, small cap or mid cap for a longer time frame. It is, however, important to note that small cap investing comes with higher volatility and significant drawdown during the periods of market correction. An investor with limited experience of investing into equity are better off participating into equity mutual funds through broader categories like large cap or large mid funds. In fact, I would say if there is a first time investor who has never invested into an equity mutual fund, he can start off his mutual fund investment journey by investing into an index fund and using SIP as a route to participate into the index fund.
So thank you, Piyush, for joining us on the morning brief, and we hope to have you again sometime back soon.
Thank you so much, Kayezad.
That's it for today. You were listening to this episode on the morning brief. It was produced by Anirban Chaudhary, sound designed by Rajas Nayak. Just to recap some of the points that Piyush said, the sweet spot for making reasonable returns while minimizing the risk of loss is 5 to 7 years. Shorter time periods might give you spurts and returns, but it is always advisable to go for stability in returns over higher returns. It's important to keep track of your funds. Do not invest in a plethora of funds that you keep losing track of. And first-time investors can also start their first 1 or 2 SIPs through passive funds. SIP is not a magic path to success. The selection of funds, periodic reviews, and mapping funds to your risk profile are very important. Keep listening to our shows, including the Morning Brief and Corner Office Conversation, wherever you get your podcasts. This is your host, Kayezad Adajania, editor ET Wealth, signing off. Stay tuned.